The Treasury, of course, will go away and they will talk with the Treasury Borrowing Advisory Committee. They did this back in May 2017, and this is what TBAC had to say to them back then. While an ultra-long is most likely to be demanded by those with longer-dated liabilities, the committee does not see evidence of strong or sustainable demand for maturities beyond 30 years. I think it's quite instructive to look at what the curve looked like back in 2017 and compare it to what the curve looks like right here in 2019, and just ask a simple question, Priya. Just how different are things now compared to then? The now is that nice steep blue line. The now rather is the white line, and the then is that nice steep blue line. Your thoughts?
So I think the curve is obviously very different. But I take issue with the Treasury's premise here that the only reason the curve is flat is that there is all this demand for the long end that does not exist, or that the supply doesn't exist. I think the curve is flat because the market is sort of saying that the Fed is ineffective or the Fed's not doing enough. We can't get inflation expectations higher. So I still agree with the TBAC statement that there is no captive demand. I mean, there will be demand, I should say. There's always price, but so as a taxpayer, am I getting the best, the lowest cost to issue this in a regular cycle method? I would say no. I think Treasury will have to pay up to issue. I'll make one point. Normally people's eyes glaze over when I talk about swap spreads, but swap spreads are highly negative. So the US Treasury is paying 40 basis points more to issue 30-year Treasuries as they are, compared to where 30-year swaps are. So that tells you there is demand for duration. There's not obviously that much demand for Treasuries. So the US Treasury is clearly trying to steepen the curve. I think the president's trying to steepen the curve. The Treasury is trying to steepen the curve. They can go out and issue it, but Treasury normally has a regular and predictable issuance calendar, which means we'll be stuck with these bonds for a long time, which means the curve can steepen. I think you can absolutely get a knee-jerk reaction. I don't think it lasts because at some point it's going to sit on dealer balance sheets. It's going to be cheap relative to other points in the curve. I would say the 20-year might be a little better than the 50-year, but the Treasury is the issuer. They can go ahead and issue it and have some knee-jerk reaction on the curve.
Tom, you think this happens?
Yeah, I do, and I'll tell you why. I agree with the argument that it's not who shows up at the first auction, it's who shows up at the 10th. And once we start getting down the line, as the curve steepens, that demand is going to begin to evaporate. But what I think the Treasury can do now is they can barbell this. They can fill a gap at the 20, and they can issue a 50-year, and more or less come out with roughly the same weighted average duration if they just issued more 30s, but they might actually be able to lower their average borrowing cost. And the reason for that, as we pointed out, the curve is much flatter now, and the term premium is extremely negative that far out the curve, which means the Treasury is actually getting paid for the option of terming out its debt.
Do you think the Treasury Borrowing Advisory Committee offers different advice this time around, or do they offer the same advice and the Treasury just ignores them?
I think they offer different advice this time. I think on average, the average contributor says it's time to go, but I don't know what the Treasury's decision is. But my suspicion is that the Treasury goes.
Julian, I know your thoughts on this bond market. You think we're in a bubble, don't you?
I do, but I think Priya hit it. Basically, everyone is incentivized to see the yield curve steepen. There is no actor that is not incentivized to see that right now. And, we think, obviously, Secretary Mnuchin is acting on the long end. We actually think the Fed is going to cut 50 basis points on September 18th to act on the short end. And the reality is if you go back to 2 weeks ago when we first inverted on 10s, 2s, this is all about confidence. There's no coincidence with the fact that we were down 800 points in the Dow and the president sent out his first tweet on the yield curve on that day.
I imagine there's a group of individuals that are short the banks that are quite happy where the yield curve is right now, Julian.
No
do you
question.
like the banks from here then?
We do.
That's your base case?
We do. Our view, if you look at the last 6 weeks, the correlation, the intense risk-on, risk-off correlation between stocks and bonds is telling you that you're going to have cyclical leadership to have a next leg up in the equity markets, and we think that's coming.